Think Realty Nation, what's up? It's Abi Golhar. You are watching the Think Realty podcast. On today's show, listen, a lot is happening in 2022. Interest rates are rising. Where's supply? Supply's been, as you and I both know, supply is supremely sucked for the last year and a half as real estate investors. I have a lot of questions about where the real estate investing space is going to be toward the end of 2022, going into 23 and 24 possibly, the impact that interest rates will have on investors, and guess what? I'm going to get these answers from the horse's mouth himself, my good friend Bill Tessar from Civic Financial Services. He is a giant in the space, and if you're not paying attention to this podcast, you're losing out. The next 10 minutes is going to change the way that you invest this year. Before we get to Bill, this podcast is brought to you by Rent to Retirement. Does 20% return on investing in turnkey rentals sound attractive? Rent to Retirement offers fully turnkey properties that are newly built or renovated, leased and managed, allowing you to invest with confidence out of state. They have single-family, multifamily, new builds across 15 markets that maximize cash flow, appreciation, and equity. Rent to Retirement helps investors build a business plan to achieve financial freedom through real estate investing. Learn more. Check out renttoretirement.com. or call or text 800-311-6781. Let's get to it. Bill, welcome to the show. Happy New Year. It's been a minute. How are things in your world? Talk to me.
Yep, awesome. Happy New Year. Yeah, I'm good to be back. It's interesting, even with the shutdown, you come in here at the beginning of the year and everybody has their New Year's resolution. So you see all the desks filled and computers on early, and I'm an early riser just by nature. So when I come in here, to actually see anybody beat me to the office is refreshing. So yeah, it's great. Looking forward to 2022.
Excellent. You're the president and CEO of Civic Financial Services. You guys have a major foothold in this space. I subscribe to the New York Times, Wall Street Journal, The Economist, and Barron's. And almost every newspaper over the last week has touched on interest rates. The Fed's going to clock interest rates up about 1.5 by the end of the year. Roughly speaking, in your guesstimate, you have a crystal ball, I have a snow globe. What impact do you think these interest rates will have on real estate investors? And maybe talk to both two sets of real estate investors, your fix and flippers and your buy and holders.
Yeah, so I spent the first 30 years of my career on the conventional side, and obviously with how the lock and fair value model works, conventionally speaking, I've kept a very close eye on interest rates for almost 4 decades. And what I would tell you is I've been calling for a rate increase for the last few years. Now, COVID kind of screwed up my pinpoint accurate description of when that was going to happen. But there is absolutely no question interest rates are going up. The question I think that everyone has is just how much. And I think just over the last 6 or 7 trading days, or 10 years up 20 basis points, I think it was just at 166. And so I think what you're going to see is long-term rates. So conventionally speaking, long-term rates, they're going up. There's no question about it. These big lenders have a huge challenge ahead of them in that they have rode this refi train for the last 3 or 4 years at record numbers. They've done the Smith loan 5 and 6 times as rates dropped down. They kept rewriting that same borrower. And I think what you're seeing right now, they're predicting interest rates, their refinances being down 65, 70% this year. And so with that, I think what ends up happening is you see, mass layoffs on the conventional side. There'll be some opportunities to hire quality people. More importantly, you're going to start seeing new products come into the market. The graduated payment mortgage, the 3-2-1 buy down, more interest only. So I think long-term rates go up. And I think short-term, like in our space, for those lenders that are interdependent on like securitizations and whatnot, their rates are going up. If you're a balance sheet lender and you're using money through the Fed window, then you're not going to see huge fluctuations there. And I actually think that Civic has a competitive advantage from that perspective, being that our funding source is a bank, and our cost of capital is ridiculously low.
So when it comes to me as a say fix and flipper, am I expecting then the similar demand that I've been seeing for homes moving into this year and possibly even 2023, even if interest rates increase a little bit? From my perspective, I'm still okay because I want more qualified buyers, and instead of getting the 25, 30 offers for the home that I've been seeing, I'll get less, but there's still demand. How does that shift my strategy as a fix and flipper?
So I personally don't believe rates going up is going to mitigate the buying opportunity the way some people do. Rates have been so low, like we joke that they've been at zero, but they've been so low that for a rate to go a 2.5 on a 10-year interest only to a 3.5 or 3.75, that doesn't really carve out a huge section of the market. I think what has happened is the lower rates have allowed borrowers to borrow more to get in a bigger house than they otherwise would have gotten into because of that purchasing power. So I think it mitigates that a little bit. But I actually don't think, the whole supply and demand that you were mentioning at the front end of our talk is, we are so far underwater right now. Some estimates between 4.5 and 5.5 million homes underwater. So I actually don't really believe that this is going to be a negative for the flippers at all. I do think they have to be conscientious about it, especially those that deal in the luxury market. And obviously out here in Southern California, we see a lot of those. But then when you get to that level above 3.5, 4 million, those buyers, a lot of them have cash. So they're not interdependent on what's going on with interest rates. So I do think it's understanding the different sections of the marketplace as it relates to interest rates. And we all should be conscientious that the lending space as a whole is such a huge monster that it will create opportunities for borrowers to get back into the borrowing pool when interest rates alone don't do it. You'll see some crazy products coming out into the market. And I think you'll also see non-QM really take an elevated stage, right? So bank statement only type of thing.
You mentioned a keyword earlier, underwater. You don't mean the same underwater from the 2006, 2007. I'm assuming you're talking about the supply that, hey, we need another 4.5, 5.5 million homes in the United States, and that would just add to the buying pool and add to the supply that people have to buy.
Yeah, thank you for clarifying that. Of course, having lived through the financial crisis, underwater during that time meant 120 to 140% loan to value, and no path out of that negative equity situation. Underwater in this term is we are 4 to 5 million homes under supply, and the demand will probably take us, I've heard, as long as 8-9 years of building before we get to some equilibrium there. I think that's probably true. But when you just take a look at the landscape, regardless of what rates are going to do this year, they go up 25, 50, 75 basis points, whatever that is. That with demand, my personal opinion is these next 2 to 3 years could be amongst the biggest in real estate.
Man, I am so with you on that. There are a lot of folks that will say, well, these interest rates is kind of last sticking point on this. These interest rates will clock up 1.5 or even if it's 2, right? On a worst case scenario, that's going to drive down buying activity. That's going to drive prices to normalize a little bit. If you really look at the dollars out, the cash out every month on a mortgage between where we are now and say 50 basis points or 75 basis points, it's not a whole lot more. It's not. And do you think, so have you read the book Black Swan by any chance?
No.
Yeah. It essentially talks about some event that has yet to occur that will completely destroy an economy. And there have been a lot of folks on YouTube and even the Journal that are talking about this idea that, hey, it wasn't COVID, it's something else that's coming that people are borrowing. It's strong right now. One of my buddies, he invests in commercial real estate in St. Louis. He buys about $10 million a year in property. And he's like, I'm just going to go cash heavy right now because I'm just feeling that there's something looming. Should investors feel like there's something looming, something that is about to happen that could turn this what you call the next 2 to 3 years, 5 years, 6 years, a great time to be in real estate, into one that is completely subpar?
So I am not a believer in that. And listen, I can't be any more clear. Going into the financial crisis, there were loans that were being done and done regularly that were stated income, stated asset to $2 million on second homes with 580 FICO scores. So people, blue collar jobs were stating they were making $25,000 a month, not having to verify it, not having to verify any liquid reserves or where the downstroke was coming, limping into $1 million loan thinking that it was perpetual appreciation. And you saw that problem coming. The credit quality of those packages were about as bad as you could imagine. The credit quality of the packages today have never been better. The average FICO score is almost 740. Average LTV before appreciation, 74 point something percent. The owners of Civic was a company called Wedgwood. They're arguably the largest fix and flip company in the nation. They purchase, fix up, and flip about 500 homes a month. Okay, and I have a regular standing 2-week meeting with their CEO, Greg Geiser, and we met yesterday. And what he's telling me, and they buy properties across the nation, and they buy the small, middle down the fairway, and luxury properties, across the board and commercial. They're saying right now, today, they have never received more offers on homes at a higher percent of list and over list, with shorter close times, shorter time on the market, and less concession requests than they ever have in the history of their business. And they've been around for 40 years.
Wow.
So if you just understand supply and demand, and you said you read or like 4 or 5 different magazines, Wall Street Barons, all of them will tell you the same thing.
Yep.
That we are underwater in terms of the supply and demand of housing.
Yep.
We are. So even with rates rising, when they're coming off the bottom and you're 4 to 5 million underwater, just simple math, I don't see any event. And listen, if there was ever an event in my lifetime, it was COVID. It was COVID. Freaked everyone out. Our industry, think about what happened to the business purpose loans. 75% of our competitors stopped lending.
Yep.
Half of those people never came back.
Yep.
Credit Suisse, which was the monster in our industry, no longer buys paper. They just finance. So if there was anything that was going to screw up the real estate market, it just happened. It just happened. So for me, and I would say that after almost 40 years of being in lending, I'm guarded. I've seen a lot of stuff.
Yeah.
I can't ever remember myself being so personally bullish on the real estate market. And I'm capitally committed personally to real estate. I'm a big believer. And there's so many different outs. There's so many different exits if some element of the market, rates, demand, supply, regulation, comes in that we weren't expecting. There's so many different outs. We haven't talked about this, but just in default, if you think about this, the default on business purpose loans right now today is at historic lows. We have a complete asset management team that would buy non-performing loans, or if a good person did a bad thing and their loan went bad, we'd have to take it back. And we always ran around $20 million maybe in default that we would deal with. We don't have any default. When somebody goes down a payment or two, they have exits.
Yep.
Because of that demand and supply that you and I were talking about. So Greg and I were literally yesterday, we're just kind of throwing stuff at one another to find what we're missing. And then combined, that's 80 years of being in real estate. So we've seen some crazy stuff. I don't see it. I'm just telling you, that's when you should probably be most scared, is when you don't.
Yeah.
But now, if you want to talk about the stock market, I think the stock market's overdone. I think there's a lot of companies out there that are valued without any real financial support, more emotion and momentum. I believe that. But when you think about real estate, dirt, owning the land, one of the partners upstairs once said to me, it was great, you'd love this. We were talking about Manhattan Beach property, and we're talking about property on the water. And this goes back pre-COVID, and he was saying, that property on the water, it's the front row. And they can't make any rows in front of that front row. And he goes, it's just like going to a Bruce Springsteen concert. You could be 7-8 rows back, pay $500 a ticket, or pay $30,000 for the front row because you're right there. And I think real estate is similar. Whether you're close to the desert, you're close to the golf course, you're close to a thriving community, you're close to the water, you're close to shopping, whatever it is, there's just a limited amount of that. And right now, it's never been more evident. And I think 3 years is conservative. It's probably more like 5.
Yeah.
Because you're going to start seeing building in areas you probably haven't seen before. And then you also have this effect, the bookend effect, where you got a lot of people from California, a lot of people from New York moving inland. So
yes.
California, you got Vegas, Arizona, Denver, Utah.
You get Texas. I mean, there are a lot of folks going to
Carolinas, Florida. And what we're seeing, like, for us, what awesome result of COVID. I'm writing a book, The Things I Loved About COVID, which, you think like that's kind of crazy, but there have been some unbelievable things. Yeah. The first thing is that we proved to ourselves we don't all have to be here in one office. So now we're allowing our executives to move to places where less state taxes, the dollar stretches further, they're closer to their family, better quality of life. And if you do that true work-life balance that you say you want for your people, you're actually living that. And we're like I think we're on a third model right now, third full-time at work in the office, third hybrid, and then a third 100% at home. Yeah. And I don't think that lasts through COVID. I think that lasts into perpetuity because they proved that they can do it. I think a lot of other companies are doing exactly the same thing, which is, unbelievable. But because of that, you do have people now that were stuck in California that had their job here that are going, maybe I'm not going to pay 14% state tax.
Right.
Maybe I can get a 5-bedroom 4-bath instead of a 2-bedroom 1-bath.
That's right.
And maybe my dollar stretches further, better for my children whom I'm raising. And it's just a different time right now.
Dude, I appreciate the insight. And I'm with you. I'm a PE guy. And so the companies that I run, we got out of our leases. We're like, we don't need this. We're actually more profitable remote than we are when everybody's crammed into a small office. You spend more time walking to get coffee. It's just, you don't need it. Or at least for my use cases, we didn't need it. We threw that old concept out the window, and now everybody's happier. You can spend more time with your dog, your loved ones, kids, whatever, and it just leads to a happier environment with happier people, with better results, with better performance, with significantly better EBITDA at the end of the day. So I'm totally with you. I also don't see a black swan at all. I also agree with you that COVID, if there was a black swan, COVID was it. And, are we surging again? Yes. Are we going to probably hit some of these peaks and valleys again in the future? Yes. Will they keep coming out with boosters? Yes. But we're at a point, I think, with humanity where we can still do business and not have the future of COVID affect us as much as it did, because we were still learning about it in the middle of last year, where everything was completely shut down. Like you mentioned, there are plenty of opportunities for real estate investors if you know where to look. We'll have to have you back because I want to talk more about the supply chain issues as well, especially with contractors. This really does apply to first-time investors because they're having a lot of hard times right now finding good people. But we'll have to have you back for that. I think that'll be good. But man, Bill, this was fantastic. It's always a pleasure connecting with you and kind of talking some shop, because not a lot of folks understand hard-hitting messages the way that you deliver it, and I always appreciate that. So thanks a lot. You want to check out Civic? Get funded. Hit up Bill and his team at Civic Financial Services. And Bill, I'll let you tell us what the website is.
www.civicfs.com.
Civicfs.com. All right, we'll be in touch. Thank you so much.
See you, pal.
Think Realty Nation, this next segment is brought to you by Housefolios. Sourcing analysis, transaction management, rehab budget tracking, asset management, and disposition, all in one software for single-family real estate. Grow and manage your entire single-family investment portfolio from one simple-to-use software. Check them out, housefolios.com, to get started. You know what's interesting about Housefolios is I use them personally, and they are freaking awesome. And I'm a techie, so just saying, it says a lot about Housefolios. We've got to talk about a new legal requirement, the Corporate Transparency Act, that's new for this year, 2022. The U.S. government wants to know who owns your business. Really important for them, I suppose. This is what's called the Corporate Transparency Act. The CTA requires, as of January 2022, you know, it's funny. I just realized 2022. I hope that's not like another repeat of 2020. It's like 2020 and like the number 2 after it, because that's how you would phonetically say 2022. Anyway, I don't know why I just thought of that. Joe, have you ever thought of that? No? Okay. Well, now we just thought of it. It's a thing. It's going to be in your brain for the rest of 2022. All right. The information will be held in a secure database maintained by the U.S. Department of Treasury Financial Crimes Enforcement Network called FinCEN. Here's the background. The CTA was enacted by both houses of Congress January 1st, 2021, as part of the National Defense Authorization Act of 2021. The required reporting is full name, date of birth, current residential or business address, and a unique identifying number from state-issued identification document. This may include a passport, driver's license, or a FinCEN identifier. So absolutely check it out. There are a lot of, and this is an article that you can read on the Think Realty blog, written by Corporate Direct, and the title is 2022's New Legal Requirement, the Corporate Transparency Act. A lot of their clients have Wyoming LLCs, Nevada LLCs, and what's the other one? Delaware LLCs. So work with your attorneys, your asset protection attorneys, to make sure what you have to disclose or not. Super important that you do that here. We're going to wrap up the show. We went a little long, but I wanted this to be a really keystone podcast for you guys and gals to listen to, because what Bill just said, super important. Super, super important. All right, we got to go. Here's how I'm going to wrap up. We've got a Houston event coming up March 24th and 25th, Houston, Texas. You want to set your calendar accordingly. You want to be there. It is in person. It is also virtual. Super, super important. You want to set your sights on making 22 a success with more knowledge and know-how by learning and networking with top-tier real estate investing pros. We're giving you a buy one, get one deal on tickets. Register for 2 tickets. You want to enter the code podcast at checkout, and you get a twofer as special pricing. Visit www.thinkrealty.com/Houston for more information. Again, use that code podcast. If you have any questions, you know how to reach out to me. Find me anywhere online at Abi Golhar, and check us out, thinkrealty.com. Until next time, happy investing.